I'm Taylor Riggs in San Francisco and for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, chipmaker rally. Micron stock hits the highest price in 18 months after the company reports earnings. We'll break down the numbers as semiconductor optimism swells. Plus, a culture of recklessness, new allegations of a lack of regard for consequences, harassment, and more at the SoftBank Vision Fund. What exactly is going on? Details of a new report. And 2019, the year in review. From content moderation, acquisitions, data privacy, to plans for a cryptocurrency, Facebook felt it all. What is the social network strategy going into 2020? But first, to our top story. Shares of Micron are up more than 3% in post-market trading. This is after the chipmaker reported better than expected top and bottom line numbers for their fiscal first quarter, and they forecast strong numbers for the current quarter. Gross margins, something I've been eyeballing all day, looking like they are stabilizing, coming in at more than 27%. Bloomberg's Ed Ludlow is here with more to break down the numbers. Ed, what is your key takeaway from this report so far?
Yeah, well, these numbers add to the optimism that you see across Wall Street and the chip sector that the memory chip market is going to rebound probably at some point in the second half of next year. It's all about DRAM, Taylor. When we talk about DRAM, dynamic random access memory, what we're basically referring to is the memory chips that go into computers, PCs, smartphones, things like that. You look at that chart, prices of DRAM trade like a commodity. They've been trickling down, falling as new technology comes into the market, as capacity comes into the market. But look at the blue line, which is Micron shares, and they've been gaining in recent weeks despite those low prices of DRAM. And essentially, despite those positive numbers for the second fiscal quarter, what Wall Street is saying is look past that to the second half of next year, where demand for memory chips is going to be driven by spending for IT infrastructure, data centers, next generation of smartphones. Yes, the price of DRAM has been trickling down, but what these numbers tell us today is maybe that market is bottoming out, and we could see a much more positive second half of 2020, which would mean more profit for Micron.
And speaking of bottoming out and profits, my eyes, of course, have been on the stabilization of gross margins, coming in at a better than expected 27%. Are we finally getting the stabilization that analysts wanted?
So margins are interesting, Taylor. If you look at DRAM, previously the only way that chip makers like Micron could boost profit was essentially to cut costs, to make sure that they were profitable as those prices were so low. But what Micron have been talking about on the call is that margins have actually been boosted by another area of the business, NAND, which is essentially the flash memory that stores data on devices like mobiles and PCs. And they're saying that they've been able to sell their NAND chips into kind of value add markets. So we'll want to hear more about that. But that's essentially what Micron has done. Its strategy has been to cut costs. DRAM accounts for more than 2/3 of its revenue, and also to look to other areas because they've been really kind of vulnerable to the cycle for chips, and that the supply-demand equation has been fluctuant for them in recent quarters. So they're basically looking at how they can diversify their business offering and make sure that they're constantly selling chips to different business areas.
Bloomberg's Ed Ludlow following the numbers. Thanks for joining us. Now, the SoftBank Vision Fund, best known for its outsized bets on tech startups. But in the latest Bloomberg Business Week cover story, Bloomberg's Sarah McBride brings to light the environment of sycophancy and harassment inside Masayoshi Son's famous fund. And she joins us now. Sarah, what I loved about your story is to get to know SoftBank, we have to get to know the founder behind it, Masayoshi Son. Who is he?
Right, he's an incredibly interesting guy. He is a Korean immigrant to Japan. He grew up in this very kind of hardscrabble way, super smart, came here to the US, attended Berkeley, moved back to Japan, started SoftBank. One of the things that stood out about his background for me was in 2000, he invested $20 million in Alibaba, and that stake is now worth $130 billion. So he's a smart guy.
And what do we know about his management style and how it has sort of fueled this environment for these outside bets?
Well, he's a go big or go home guy. So he just wants his portfolio companies and his investment professionals to just keep thinking bigger, bigger, bigger. So sometimes that's great. Like when a young entrepreneur comes to him and he tells them, oh, you're going to be the next Jack Ma, your company is going to be even bigger than you think. Have you thought of this business idea or that business idea? But then sometimes he gets impatient. We have this detail in the story about how during a conference call, he was talking to one of his investment professionals about Full Truck Alliance, a Chinese company, and was basically saying, why are your outlooks for this company so small? This company can be big, and was sort of berating this guy on the phone for not thinking big enough in a way that made other people on the call feel embarrassed.
And when we talk about some of these outside bets, Sarah, frankly, we wouldn't be here. We wouldn't be focusing on the company so much if it weren't for WeWork and sort of the big debacle of WeWork. Do we know anything about if WeWork has structurally changed anything within inside that culture of SoftBank as you just described?
Well, after the WeWork derailed IPO, they really had to rethink things. And Masayoshi Son expressed a kind of, he said he regretted how everything had played out at WeWork and how it had created some changes in thinking inside the fund. They're still going to think big and press people to grow their companies as hard and fast as they can, but I don't think it's going to be growth at all costs anymore.
How has some of that changed as we take a look at the new vision funds that they're trying to raise? This Vision Fund 1, very successful. Some of it bleeding now into Vision Fund 2. What do we know now about the differences and maybe the challenges with the second Vision Fund?
Well, here's the thing. The actual members of the public just know about WeWork and associate the Vision Fund with WeWork. But WeWork was just a $4.4 billion commitment out of a $100 billion fund. So they have all these other investments, some of which have a lot of potential that aren't WeWork. So when they go out and pitch investors on Vision Fund 2, it's not all about WeWork. Yes, that's the headline company, but actually there are so many other companies.
And how much of these, some of the bigger losses, like a WeWork, Uber, which its IPO hasn't been successful by some measurements, sort of masked or offset the other successes that the Vision Funds have had?
Right. So even WeWork, when the Vision Fund first invested, that was at a $20 billion valuation. So they never invested at the higher valuation that others did, including other parts of SoftBank. So their losses haven't been as bad as some of the headline numbers. Uber, that company's down from its IPO, but SoftBank's Vision Fund invested long before the IPO. So yeah, I mean, the results aren't great and they're dragging down some of the other results. A lot of the results, though, at this point are on paper only. They're marking up the valuations of some companies that haven't gone public and haven't had an exit yet. That's perfectly legal, but it's just a paper increase, not an actual increase at this point.
And if Silicon Valley knows anything, they know the difference between paper money and real money. Bloomberg, Sarah McBride, thank you for joining us. And you can read more of this story and more in the December 23rd issue of Bloomberg Business Week. Now, shares of Tesla closing at a record high of $393 on Wednesday after reports the company is considering cutting the price of its China-built Model 3 sedans by 20% or more next year. Tesla is betting that the move will lure buyers as the world's biggest electric vehicle market slows. Tesla stock has surged more than 50% since the company reported a surprise profit on October 23rd. And coming up, Uber doesn't want to be known as just a car booking service. It's taking the gig economy model one big step further. That's next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. With just a week left before Christmas, it is do or die time for the delivery machine Amazon has been assembling over the past few years. as it's ditching longtime logistics partners like UPS and FedEx. The e-commerce giant is beefing up its own delivery system to prepare for the strain of holiday orders and expectations. Joining us to discuss what Amazon has in store, Bloomberg's Spencer Soper in Seattle. Spencer, we know that it's always a tough time, a big test of the year for all these logistic companies. But what is Amazon's big test in the next 2 to 3 weeks?
Well, the big things for Amazon are it's handling more of its deliveries than ever before. So it's estimated about half of all Amazon packages will be delivered by this system that Amazon's created. This is independent contractors who start their own businesses by leasing a bunch of vans and hiring people. It's also these flex drivers, which are kind of do like an Uber type app where they use their own vehicle and deliver packages for Amazon. It's the first year that Amazon is doing so much of its own last mile delivery so aggressively. And we've got, some hints of bad weather coming. That's always the big wild card, the thing, a system that can work great through decent weather can break down in bad weather. So a lot of it's going to be dependent on Mother Nature.
Well, and those are things that are outside its control, and there's also things that are inside its control, like that last mile. Have they mastered that last mile delivery?
Well, they're spending a lot of money on it, and they're doing a fairly decent job. They're, independent experts who monitor the shipping things are saying they're hitting, 90% plus, basically on par with FedEx and UPS. They're also doing things differently than UPS and FedEx, and a big part of it is having, multiple trucks or even these backup flex drivers hitting the same neighborhoods on the same day. So, when you think about seeing a postal truck, you'll usually see it maybe once a day, and then it's gone. You won't see it again until tomorrow. You might see multiple Amazon vans and vehicles crisscrossing your neighborhood on the same day. That's considered inefficient in logistics, but Amazon is saying, this is necessary to provide the capacity we need and to get everyone their packages in time for Christmas.
And Spencer, am I right or jumping too many hoops if I wonder if we should start looking at Amazon as a logistics company, no longer an e-commerce company?
Yeah, they've been a logistics company for years. It's always been more the back end part, the warehouses and storage and packing items, that sort of thing. So they've been in the logistics game for a very long time. We're just seeing them, increasingly branch out from that with the planes and now with the last mile of delivery, which is really the most visible. So, you may be used to see most commonly the Postal Service truck and the big brown UPS truck. Now you're likely seeing those blue Amazon Prime vans as frequently or more frequently than you're seeing anything else.
Yeah, Bloomberg, Spencer Soper, thank you for joining us. Now, despite pressure from governments worldwide to give its gig drivers employment benefits, Uber is expanding the gig economy model beyond just transportation. The ride-hailing app on Wednesday announced Uber Works. It's a program that connects workers with businesses for temporary staffing services. For more, I want to bring in Bloomberg's Eric Newcomer in New York. Eric, what do we know about Uber Works?
They were testing this in Chicago, and I think the next city they're doing Miami. And the idea is, okay, Uber, we're good at getting drivers. We can hire, maybe a laundry worker, other sort of independent type workers that you would get sort of through a staffing agency. So, Uber, I think the important thing here is, they want to say they're a platform. So on one side, they've said, okay, we're not just going to deliver rides, we're going to deliver food, and we'll think about other things. But they don't want to ignore the other side of the platform where, okay, we're a provider of jobs to drivers. Can we provide other jobs?
And anything special about Uber Works versus a traditional staffing company that you mentioned?
I think Uber's always going to say that it's sort of their technological know-how, their ability to sort of on the go place people in a faster way. They obviously also have just this huge brand to recruit workers and their existing network of drivers who might want to look at other types of jobs.
You know, Eric, you mentioned that Uber wants to be the platform. So clarify, sometimes I talk to analysts and they like Lyft because it's a pure play company. They're focused, they're targeted on their goal. Other analysts really like Uber because of the diversity, because of the logistics, the freight, the Uber Eats, Uber Money, Uber Works. What is it? Is there a key winner here in terms of a diversification strategy?
Well, I don't think either company is winning relative to their IPO price. But, you know, when Uber went public and today its losses were huge. And so the only way you can get away with multi-billion-dollar losses is to say we're using it to fund all these ambitious projects. So like you said, we heard about freight, we heard about the growth of food delivery, and every other sort of new idea under the sun. And this seems like another example. But I don't think it will allow Uber to escape the core challenge that it needs to prove that the ride-sharing business is a good one that can generate profits in the long term. And so, you know, I think this is interesting, but I think at the end of the day, you know, rides and then eats to a lesser extent are really going to define Uber's business for the foreseeable future. And so, you know, it's nice to be able to say we have these other projects, so you should invest because there's a growth opportunity. But when there are sort of fundamental questions about the core business, you know, that's driving the stock down. I think it's some 30% over the course of the year.
And Eric, some of those fundamental questions are about regulation. At least here in California, AB5 was seen as a huge headwind for the gig economy and companies like Uber. Any threats of regulation now on the other sectors of the gig economy where Uber wants to enter into?
Right, definitely. I mean, I think from the business world, there was a sense, well, these are these huge startups now. Everybody's using independent contractors. They'll figure this out. But from governments like California, we're seeing clear signs that, no, governments are just slow to move and that there's still plenty of scrutiny on independent contractor status. So, you know, that's still playing out. The law takes a long time. Like the Dynamex case, which is a key piece of case law for the independent contractor thing, took years to play out. So this is a long, slow process. And I do think it's interesting that Uber is sort of diving headfirst into independent contractors with Uber Works while there's all this pressure on its core sort of employment model.
The irony of it all. Thank you to Bloomberg's Eric Newcomer for breaking it down for us. And coming up, Instagram making serious changes to its influencer policy for the first time. How the social media company is cracking down on vaping next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg. Let's get to today's top tech calls. Datadog started with a buy rating at Rosenblatt Securities, which wrote that the company was well positioned to benefit from growth in the cloud monitoring market. The firm issued a street high price target of $50 while saying that the valuation reflects one of the highest revenue multiples and highest revenue growth rates in the software universe. Twitter's price target was cut to $36 a share at Citi, with the firm updating its model to reflect the social media company's third quarter results. The analyst said that we remain largely concerned on the near-term revenue outlook. And Peloton's price target was raised to $39 a share at Bernstein, which said that unit economics suggests that margin profile may be higher than previously forecast. The analyst sees potential for 30% profit margins by 2034. And those were a look at the top tech calls. Now I want to move on over to Instagram, finally making rules to govern content in influencer advertising. The app's most followed users who are paid by brands to post will no longer be allowed to promote products related to vaping, tobacco, and weapons. Bloomberg Technology's Sarah Fryer joins us with more. Finally, Instagram sort of taking a very much more hands-on approach to their influencers.
It has been this Wild West in marketing where influencers really are making their own deals with brands on what they get paid and what they say. And Instagram itself is not really a part of that discussion. However, there has been a lot of pushback from regulators as of late, the UK Advertising Authority, the Federal Trade Commission, saying that there needs to be some restriction on influencer advertising, specifically in vaping, which has been targeting teens, as you know. And so this is really the first rule that Instagram has ever made to try to regulate that community.
And how much of this, like you said, is pushback from the regulations, from the health officials, given the concerns about vaping, for example, and Facebook and Instagram saying, okay, now we need to do something?
Well, Instagram, to their credit, is not just talking about vaping here. They're saying that they're not going to allow ads on vaping, on weapons, or on tobacco products. So this is a little bit of a widening of the rule. That said, there hasn't been a lot of enforcement by Instagram on these rules for influencers. Remember, a few years ago, Instagram said that all influencers had to disclose if they were getting paid to post about brands. And often we see influencers still posting paid by brands and not disclosing that which is required by the FTC.
And this isn't new, because a few weeks ago you and I spoke, and Instagram said that if we pay for your content, you are not allowed to talk about politics, for example, and a host of other issues. Is this along those same lines and sort of expanding the category at which if Instagram is paying for your video, that topic is off the table?
Well, it gets really complicated because you have the regular advertising system, advertisers buying ads through Facebook and deciding to put them on Instagram. Then you have regular branded content, which is, advertisers working with Facebook and Instagram to do that. And then you have this influencer advertising market, this sponsored content market, which is sort of outside the visibility of Instagram and Facebook in many cases, and is operating just as a relationship between the user and those brands. But increasingly, that content is very popular and making up a lot of the content on Instagram itself.
How do advertisers feel?
Well, I think advertisers were kind of looking at influencer marketing as a place where they could do whatever they want. And so now they're going to have to be a little bit more careful. The other thing I'll say is Instagram just started asking its users what their birth dates are. And another portion of this restriction rolling out sometime next year is that they will start to limit who can see ads about alcohol, about diet products, and other things that should be age restricted.
And quickly here, we know that Europe has been much more strict relative to the US. You'd mentioned that the UK's Advertising Standards Authority this week came out with that ruling on tobacco. How much is the US playing catch up to what we're seeing already in Europe?
Well, the US FTC has been very interested in Juul in their marketing to youth. So I think that's sort of playing into it here is who is getting this message and how, and influencers play into that quite a bit.
Bloomberg Technology's Sarah Fryer, thanks for joining us. And coming up, we dive back into Micron's earnings as the street looks for bottoming out memory chip prices and stabilizing gross margins. Matthew Bryson of Wedbush gives us the latest from the analyst call that is currently underway. This is Bloomberg. This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Taylor Riggs in San Francisco with Sherry Ann in New York and Paul Allen in Sydney. Now let's take a look at the top global tech stories of the day. Sherry.
Taylor, Tesla may take a big step to ramp up sales in China. Bloomberg's learned that the car maker may cut the price of its China-made Model 3 sedan by 20% or more next year. Tesla is betting the move will lure buyers in the world's largest market for electric vehicles. New York City is waiting on Apple. A year ago, Apple announced it was bringing hundreds of jobs to the city, but now New York's real estate industry is wondering when the company will make its move. Apple has a limited presence here beyond its popular retail stores. Meanwhile, Google and Facebook have become two of Manhattan's biggest tenants. It's a sign tech companies are tapping into the educated workforce. Apple, Google, Amazon want one language for smart home devices. They're joining up with the Zigbee Alliance, which promotes standards for the Internet of Things. The goal, to come up with a way to make internet-connected homes easier to set up and safer to use. An increasing part of the home can now be controlled by voice-activated speaker or remote apps. Those are the top global tech stories we're watching. Taylor.
Thank you, Sherry. Now, Micron reported a strong showing on Wednesday when the chipmaker reported first quarter earnings. Micron impressed Wall Street with a strong outlook of between $4.5 to $4.8 billion in revenue. Shares in after-hours trading jumped as a result. With more on the analyst call, it is Wedbush Securities analyst Matt Bryson. He has an outperform on the stock, and he was on that call. So, Matt, talk to me. What was your key takeaway? What did you hear from management on the call?
I think there were a couple of things that were important. One is they are seeing tightness in certain areas in DRAM. Also, they're calling a bottom for memory in general. They think this current quarter is going to be the bottom of the cycle. That fits with the tightness in certain areas of DRAM. That fits with the fact that they saw NAND pricing move up in the quarter just reported. It also it very much parallels the guidance they gave for flat gross margins, which again suggests that pricing is normalizing finally.
So, Matt, pricing normalizing finally, signs of tightness. Does this have any implications for CapEx or an expansion of capacity?
So I think at this point they are remaining conservative in their CapEx outlook. They're keeping their CapEx guidance steady. I think that's the prudent thing to do, to wait for demand to come back. They did note that there is a point of uncertainty in terms of how much inventory China's accumulated. Just coming back from Asia, that's something I continue to hear from systems builders over there. So I think they're taking the prudent course right now and not yet investing in CapEx. If the recovery continues, I'd expect that memory in general will look to support their customers and expand capacity, but that's not happening yet.
Matt, I'm showing a chart to our terminal audience right now in my terminal, which is, as you described, the share price of Micron, and then it is the lower and lower DRAM and NAND memory chip prices. We've been calling for a bottom really for a lot of 2019. Are you confident that we've truly hit a bottom in those memory chip prices?
So I think on NAND, I am. Looking at pricing moving forward, I believe that contract negotiations around solid-state drive pricing have been concluded favorably for calendar Q1, so Micron's fiscal Q2. When you look forward in the NAND space, you've got a huge driver of demand in new gaming consoles, which are shifting from hard drives to SSDs. And then you also have an added boost in a better handset outlook, in part predicated upon 5G. On the DRAM side, it's slightly more difficult to call. Having said that, I'm starting to hear that server DRAM contract is moving up. So in my mind, that's the first sign that we've really bottomed on the DRAM side. Also, spot pricing over the last couple of weeks has started to rebound. The large cloud customers, who are an important point of demand for DRAM, have increased their buying. And so, while there's not quite as much visibility there, I think that we have seen a bottom.
Matt, we have Micron shares up 60% from their June low. How much further do you think they've got to run there? What's your expectation for the share price?
So I've got a price target of 65, which is about 9 times my prior EPS estimate. That, however, only assumes gross margins in the mid-40 range. So last cycle, the margins topped out at 60%. So I would say there's certainly room to move up in the mid-60s, and if you have a relatively strong cycle this time around, I think my estimates could certainly go up from where they are right now.
Matt Bryson of Wedbush, thank you for joining us straight from that analyst call. Plenty more global stories when we return. This is Bloomberg. Now to our week-long series, Big Tech 2019 Rewind, where we look at the world's biggest technology companies and the challenges they faced over the last year. Facebook ended 2019 much as it began, under political and regulatory pressures over content moderation, acquisitions, data privacy, and plans for cryptocurrency. The social network's newsfeed proved no longer the lone crown jewel it once was. Acquisitions of Instagram and WhatsApp became more interesting in terms of their performance and potential.
Everything's growing. Facebook, Instagram, Messenger, WhatsApp.
Instagram and WhatsApp have been the breakout successes for Facebook, with ad revenue and record-breaking app downloads. But Facebook's plan to integrate their platforms have caught the eyes of the Federal Trade Commission, which may try to stop the plan to merge the technology platforms. And this isn't the FTC's first look at Facebook. This past summer, the social network was slapped with a record-breaking $5 billion fine as part of a settlement over consumers' privacy rights.
Facebook betrayed the trust of its users and deceived them about their ability to control their personal information.
Data privacy is now also the focus of the European Union's Commissioner of Competition, Margrethe Vestager. She's investigating how data may be used to unfairly stifle competition. And no place was more focused on Facebook than Washington, D.C., where CEO Mark Zuckerberg appeared many times. At Georgetown University, he defended his decision not to fact-check ads from politicians.
As a principle, in a democracy, I believe that people should decide what is credible, not tech companies.
And it was Zuckerberg's congressional appearances that likely generated the most interest, as Facebook's cryptocurrency plan, called Libra, was called into question by lawmakers.
Is it a currency? Are you a bank? What is this association?
It's a very complex project, and as you say, it's risky.
And so Facebook enters 2020 in a risky place. With Libra set to launch in the new year, the project is now under review of the U.S. Justice Department, the FTC, and nearly all the state attorneys general. And with that kind of pressure, we'll have to see if Facebook investors stay or shy away. Here with no shortage of perspective is David Kirkpatrick, Techonomy CEO and founder. Also with me, Pivotal Research Analyst Michael Levine. David, let me start with you. Arguably what is shocking to me about this entire thing is the price share run up. Come and take a look at a chart that I'm showing inside my terminal. Despite all of those headwinds we just discussed, Facebook is up 54% year to date. What do you make of this?
It really creates some cognitive dissonance for me. And makes you realize Wall Street just doesn't care about anything except growth and earnings and revenue. And in a year when Facebook got a $5 billion record fine, gigantically greater than any other company's ever been fined by the FTC for a privacy matter, and their stock still performed beautifully well for the year, you really have to say, well, we're not going to get any help from Wall Street in reining in a company that really needs to be reined in ways that frankly are hard, but let's face it, somebody's got to do it.
And Michael, I want to come and take a look at a chart that I also made especially for you, and it is the forward PE ratio of Facebook. I'm charting this relative to the other big competitors out there. Facebook, frankly, still undervalued according to that metric. Is that in part why the share saw the big gain this year?
Well, in terms of the gain, I mean, You'd had really awful performance in 2018. You had a couple quarters in the back half of the year where they basically missed numbers, so had derated pretty profoundly. I'd say if I look at even the reaction to conceivably trying to block the integration, which could be obviously a precursor to trying to break up the company, I think you actually are seeing a reasonable amount of conservatism factored into the multiple. I mean, since we launched coverage on the company, one of the tenets of our initiation basically was we've never seen a more hostile regulatory environment. So, I mean, I think truth be told, a lot of people were initially surprised that the stock didn't react more negatively to the headline, but there's an element of it's sort of been playing through if you look through a lot of the other names in big tech and the moves they've had this year.
David, comment on some of those antitrust issues that Michael was alluding to. Is there a case to be made for breaking up this company?
I'm not an advocate of breakup, but there's no question that the regulatory pushback this company's facing all over the world is really not like anything any company's probably ever seen. I mean, there is movement, against Google and to a lesser extent Amazon in a lot of these places too. But Facebook is the company that regulators are looking at in the EU, parts of Asia, the United States, both parties here. And it is true, despite the fact they had a pretty good year on balance in their stock, that they're still below their high. And they've been hurt by all these controversies that never seem to leave them. So maybe Michael's right. That it is factored into the stock. It's such an incredibly profitable company, and they have such an incredibly good ad business, which is Michael's expertise, that you've got to give them credit for that. And if you want to make money in the market, this is a company that's going to keep raising its revenues and profits.
And Michael, as an analyst who covers the company, do you like what the company is doing in terms of trying to integrate all those platforms together?
I mean, is it just greater cement their control and, ostensibly why the government's conceivably trying to go after them? Yeah, it likely does. I mean, they have definitely not had a lot of success to date monetizing Messenger and monetizing WhatsApp. And a big part of why they've been so successful monetizing Instagram is they've got this phenomenal targeting engine and they've got the strong ad base in place, and you just can do a better job monetizing any of these assets better than pretty much anybody besides Google. So,
Michael, you talk about that, but one thing that struck out to me is Instagram Stories was effectively copied from Snapchat. Do you get nervous when the big ad engine of Facebook is a product that was copied and not innovated from within?
I think if you look at what they've done quite a bit of emulation. I mean, I'm trying to remember that expression, but basically the ultimate form of flattery is emulating. I mean, there's some things that they've innovated on, and there's a lot of it's something that's classically happened in tech for years. So have I been consistently blown away with what they've come out in terms of as new platforms? No, I have not. But as David mentioned, they've built a very good, durable ad business that performs for advertisers. So that keeps the dollars coming in the door.
David, I want to flip on over to Libra. Dead on arrival?
Well, I actually think they made a huge mistake announcing Libra when they did. I mean, as Zuckerberg said in your clip, it's a very complex thing. Why bring a new complex issue into your public relations and government relations strategy when you're already under incredible threat of government regulation for a bunch of other reasons, and why you have basically very little public approval? I think that was very foolish, and I think partly because of that, there's no chance that Libra is going to actually get launched anytime soon. Plus, Zuckerberg has said he will not launch it unless he has regulatory approval both in the United States and the EU, which to me means, yes, for now, it's dead.
Michael, I'm curious about your take on Zuckerberg's relationship with DC. You mentioned it's one of the most hostile regulatory environments. Yesterday, we were talking about Apple. Tim Cook arguably has a great working relationship with the president. He has his ear. What do you want to see from Mr. Zuckerberg in terms of improving his relationship with DC?
I think it's pretty tough to do. I don't know if I've got a magic answer for you on that one. I mean, at least I feel like, was hearing from some of the troops as they were under assault last year in the press, and it's not like it wasn't warranted, some of the things that they were getting attacked for. I felt like there was this initial, everybody's in a bunker, and I mean, he's gone out, he's tried to tell a story, and I think they've certainly learned from this. I mean, I think they are being more proactive. I think they recognize they're under a greater degree of regulatory scrutiny. But, look, I understand DC's opinion, and I mean, it's certainly going to be a political year. There's no doubt.
David, your thoughts on Zuckerberg's improving relationship with DC?
Actually, I think that there's a real similarity between how Tim Cook and Zuckerberg are treating the president. They're both cozying up to him. They're both more or less trying to do what he wants in order to keep him off their back. And it's a president who responds very well to flattery. And, who knows what Mark said when he was in the Oval Office with his board member, Peter Thiel, who spoke on behalf of the president at the Republican convention. But, that was a pretty friendly thing to do, to go and, schmooze with the president secretly. And then let's just face the reality that his moves to, refuse to regulate political advertising is exactly what the president would like. So I think that's fairly savvy, especially if he believes, which he seems to, that the president will get reelected.
Okay, one quick question to both of you. I want to look at the company into 2020. Michael, could this be a top pick? Where do you see the stock going after a 54% run up this year?
I mean, if I roll forward to 21, which, considering the market's basically on its highs, as a general rule, I feel like that's where the buy side's going. I feel like it could probably get 250, 260 to the upside. I mean, what makes it maybe a little bit more challenging, there's not as much of an element of surprise. So Street's at around $11 in GAAP EPS. The buy side believes it's more like $12. So as a general rule, you want to see companies that are beating and raising versus expectations. Where I struggle with it is I don't believe where some of my peers, and I hear from some of the buy side, they should be trading 24, 25 times GAAP EPS when you've got this regulatory overhang. And look, I'd frame the regulatory overhang. What I've heard some of the buy side do is say, if you break it up, there's revenue dyssynergies, and fine, $12 goes to 10.5. So that to me really simplifies what would be an extremely challenging thing for Facebook to do, given a pretty tight labor market.
Yeah. David, your thoughts quickly here, Facebook in 2020?
The only thing that's really going to hurt Facebook from a stock perspective long term is if real regulation begins to be imposed. GDPR is really the only thing they've faced so far. I think that could happen this year. Probably it's a little further out. The other thing is if statistics really emerge that affluent users in developed countries are stopping their use of Facebook, which I do think is possible. I think there's clearly a trend that the most affluent customers they have, users, are not as enthusiastic as they used to be. They're trying to make up for it in the developing world, but that's a problem.
Thank you to David Kirkpatrick, founder of Techonomy, and Michael Levine of Pivotal Research. Much more next. This is Bloomberg. Hotel chains and home sharing sites have been encroaching on each other's turf, and the latest player to blur the line is hospitality startup Sonder. Its model is a mix between WeWork and Airbnb. Now with the $1 billion valuation, Sonder is making a move into traditional hotels. I spoke to Sonder CEO Francis Davidson on Tuesday about the business model and how he plans to make Sonder stand out.
The way that Sonder works is by partnering with developers, and effectively we lease buildings. Last quarter, about 72% of the properties we took on was the entire building we managed. The idea is that we make spaces really attractive for travelers. It's kind of a next generation hotel experience, one which usually offers you an apartment, a studio, a multi-bedroom apartment sometimes, and also recently actual hotel rooms. So we offer a wide range of accommodations, but with always extraordinary design, and we use a lot of technology to make the experience really frictionless.
So very competitive space. Is the technology why I would use Sonder instead of someone else?
I think it really, there's $1 trillion a year that's spent on accommodations globally, and there's a lot of players. Marriott, the biggest in the world, has just a 4% market share. So there's a wide range of choices that consumers have. I think at the end of the day, what they love about what we offer is that they get a really attractive, sizable property for a cost that's usually a fraction of a hotel room. So it's just a better experience at a lower price, and that's usually kind of the main reason why people stay with us.
So you mentioned Marriott, and it was interesting. You made some comments earlier that you wanted your revenue to top Marriott's by 2025. They pull in $20 billion annually. How are you getting there? Where are you in that goal?
Yeah, so the proposition is so attractive to guests that are staying with us that really it's quite easy for us, with minimal to no marketing spend, to reach 80% plus occupancy rates. And so the growth is entirely led from the real estate that we can bring onto the platform. So it's really supply side limitations. And so the mathematics is if we're capable of adding X number of markets and X number of properties in each market on a quarterly basis, then we arrive at like a really large business quite rapidly.
How How long are your long-term leases that you're entering into?
They're typically 5 years, actually with renewal options on our side. That's one big differentiator from other kind of real estate tech-enabled companies, that we're really careful about risk mitigation. So it's not just the lease durations that we care about, but also making sure that there's downside protection built into the leases. If economic conditions change, our rents go down. So there's a lot of innovation that goes towards kind of the financial structuring of our business.
And I wanted to ask about that. How much of your business is tied to the economic cycle? If we hit a downturn and you're on the hook for those leases and yet no one's coming and renting from you, how exposed are you to that?
Absolutely. So this is something that's really was critical to our investors. Saunders raised about $400 million of capital to date. And so we've looked at every recession that's occurred. What happens to hotel revenues? And we've built into our leases a reduction of costs of rent that occurs that is triggered by a recession. And so we're carefully kind of planning the downside scenario. We know we're 11 years into a bull market. And so it's critical for us to really think about, hey, if there's a recession in 2021 or in 2022, what do the financials of the business look like? And we always make sure we're prepared for it.
How many questions from investors did you get differentiating yourselves from WeWork in the midst of all the WeWork hysteria that's going on the sidelines?
Yeah, I think it's no surprise to the world of venture capital that the WeWork business didn't work quite well in the last few months. It was kind of a response to a lack of focus on unit economics, poor governance, things that at Sonder for the last 2 years we've been obsessed about doing in the right way. We've even published our Series D deck, which shows our unit economic progression throughout 2018. So we've been extraordinarily transparent because in our view we're quite proud of the kind of financial viability that we've built into the business. We think the public markets are going to love the story.
So you make it clear that you're not an Airbnb competitor and you're not an apartment listing platform. Do you consider yourself a real estate company?
I think a tech-enabled hospitality brand is probably the way I'd describe the business. At the end of the day, we sell experiences for consumers.
You said that you were looking forward to the public markets looking at you. Plans to go public?
There's no specific timeline, but I think within the 18 to 36 month time horizon is a possibility.
That was Sonder CEO Francis Davidson. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. And be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.